Hello everyone. By far the best way to learn how to do the cash flow statement is to practice or to see it done. So that's what we're going to do here. We provided you a Word document with the financial statements for Henderson and Excel spreadsheet showing the information of the calculations. And then this video, I'll try to walk you through what happened. Went from income statement to balance sheets to a cash flow. Cash flow is always done last because we do not have enough information until we have completed the other financial statements. All right. Now, we didn't do a statement of equity. We're going to assume there were no significant changes in equity that we can't discern from the balance sheet. But in certain cases, you'll also need a statement of equity to understand what the changes were there, especially if there are multiple changes. All right. So, jumping in, I've tried to put both on the screen at the same time. That will make it a little bit awkward, but hopefully that will get us the process. So, on our right is the income statement, and a page down on that side. And up above is two balance sheets. So we have the balance sheets first, then the income statement. So start with, anytime you do a cash flow, first thing to figure out is the change in cash. So we take the difference between the cash at the end of the year and the cash at the beginning of the year, and that gets us 662. In millions, thousands, doesn't matter. We're not worried about that as much as we are the process here. Okay, so changing cash 662, that is what we need to explain. So until we have that, there's not much point going forward. All right, so we're going to jump into the operating cash flow section. Always starts using the indirect method with the net income. So we page down to the income statement, and we see that net income 2489. So we plug that in to our net income, the first number in our operating cash flow section. And there's three pieces to our cash flow operating section. Non-cash expenses get added back, gains and losses, and then the hard one, or the longer one, changes in operating assets and liabilities. All right, so jumping into non-cash expenses, we try to discern what those are. We immediately look for depreciation or amortization, two things that are non-cash. We record them by crediting accumulated depreciation, debiting depreciation expense, not by paying cash. And we find that depreciation for the year on the income statement is $1,580. So we add that. And we note that in our research, and this would have been had either be told to you or you'd have to have it some kind of a note to the side, or you'd have to find it as you went through the general ledger. 214 non-cash expense was included in selling and generation. Probably some type of stock plan that was used as compensation instead of paying cash, so you were given stock. So that is a non-cash expense, and so that gets added back to the 214 over here on our left. So those are our non-cash expenses. We look around, maybe do a little more research. We can't find any additional ones. So we move on to the next section. Gains and losses. We had a loss on the sale of property, plant, and equipment. So we add that back. We just take the loss amount and add it back. And then we had a gain on the sale of investments. Some more information on the notes, in the notes down at the bottom here that we would need to know for fully take care of this. Gain on sale of investments, 46. But all we need to know for the operating section is the gain or loss. So we add the loss, subtract the gain. We do exactly opposite of what was on the income statement because we are literally they're not related to cash, and therefore we just are essentially taking them off our calculations because we need to get back to what was actually cash was done from a cash basis. Now we're going to jump into the other piece, the longest piece of the operating. And that is facilitated greatly by having our balance sheet side by side. So if you don't already have that, okay, then you'd want to make sure your spreadsheet was set up that way. So we can make it really easy to see the differences between our operating assets and our between the 2 years for our operating assets and our operating liabilities. So jumping in to the operating assets, we're looking for typically any asset that directly impacts net income. The shortcut is to think, well, that means for the most part, current assets, unless we have reason to believe otherwise. So increasing accounts receivable. So accounts receivable side by side, we take the difference. We can even take a formula off to the side and take the difference. It's going up. So an increase in an asset, all right, is subtracted. So that is the difference there, 225. And inventory went up by 34. We're going to subtract that. Prepaid expenses went down. So we're going to add that. That seems to be all of our operating assets. All these are long-term assets. That's what we deal with in the investing section. So we're going to skip down to the liability. The first one we come to is current portion of long-term debt. Now, long-term, that's just how much of the debt is due in the next year. So it really is the same as long-term debt. And long-term debt does not have a direct impact on net income if we make a journal entry to that. So that is not an operating liability. So we skip to interest. Yes, interest payable. When we change that, it goes to interest expense on the income statement. So that sounds like all the other current liabilities do impact net income directly. So interest payable, okay, went down 48. So we paid it off. So it's a negative cash. Accounts payable went down 199, the difference between the two. Self-insurance liability jumped up by 321. So that's stuff we did not have to pay. That's why we owe more. Okay, accrued salaries, paid off some of those. They went down. Deferred revenue went up. We must have gotten more deferred revenue or cash in than we earned. And income taxes payable, same thing. Okay, we must have more income taxes that we need to still pay, which means we didn't pay it. We didn't spend the cash. And then there is one other note. Deferred income taxes, because it's income tax, even though it is, according to the FASB, a long-term liability, it still needs to be, the change needs to be in operations. And I've provided that little note here to the side. Okay, so we take the difference between that, and that actually went down, so those were paid off or used up, and so there we have a decrease in deferred income taxes. As our last item in operations. So cash from operating activities starts with net income and then includes all of these. Just add them up because we put the ones that are subtracted in parentheses. So you can just do a sum and you get 4,017. All right, so that's the hardest section. Well, the longest section. 4,017. Now, time to do investing section. Okay. So this is cash from long-term assets. So we're looking at the asset section here. We've got some property, plant, equipment. We've got investments. We've got other assets. Now, looking at our little footnotes, coming back to this information. We sold property, plant, equipment. It cost $400 for cash of $42. All we're worried about is the cash. So we take that cash amount and put it there as the cash from the sale of property, plant, and equipment. Same thing under investments. We put the cash there. So those first two are easy. Just pull them right off that little note, okay? And we're good to go. Okay? Now we need to figure out if we bought more investments. We know we sold some, but if we sold some that cost $384, we would expect our investments to go down $384. But they only go down, as you look at it, 39. They went down by 39 instead of 384. So we must have bought the difference between, and you could have figured this out on a T account, or just work it out by saying, okay, it should have gone down by 384. It went down by 39. So we must have bought additional investments of 345. Okay, same thing applies to property, plant, and equipment. It went up by $997. What we know so far is that we sold equipment that cost $400, right down here. So we would expect it to go down $400, but it didn't. It actually went up. So we must have bought some more. Okay, and it went up by $997, and we had to get enough to cover the sale too. So if we sold 400 but it went up by $997, that what we really had to happen was we paid cash for the new property, plant, and equipment for $1397. Okay, remember we have to separate, according to GAAP, the cash paid for property, plant, and equipment from the cash from the sale property. You can't just look at the net. And the same thing with investments. However, with other assets, because we don't have detail, we're going to be fine with just recording a change, cash paid for other assets, because our other assets went up by $378. So our total cash from investing activities was a negative, as we would expect it to be, because we're buying these assets and we're going to be buying more than we're selling. So we expect that to be, that's usually a good thing to have that negative. Cash spent, all right, or cash spent on investing activities would be how we would word that. Okay, next we want to go to the financing, which has to do with our long-term liabilities and stock. Okay, so following the perhaps not the best order on this sheet over here, but maybe the easiest order. We go to common stock or sale of stock. All right, and we always consider common stock and additional paid-in capital together, because we always do that together when we sell new stock, and we can figure out that change, okay, is 252. Okay, it went up by 252. So we would think, well, we must have sold stock for 252, but that's where, or 253. That's where the 214 of non-cash expense, that's the other side of that journal entry. It would have been stock. And so that part is non-cash. And so the cash we actually received from the sale of stock is only 39. Okay? Cash paid for treasury stock, just the difference. Our treasury stock went more negative, which means we bought shares, we spent cash. All right? That's always a contra equity account, like we learned in an earlier week. Okay, dividends paid, leaving kind of our hardest ones to the last. Dividend paid, we retained earnings. We would expect it to go up by $24.89, right? If there was no dividends, we would expect it to go up by $24.89. That's the amount of the net income. But it only went up by, if you take the difference between retained earnings at the end of the year and the beginning of the year, $474. Well, the only way that could be explained is if some of that 2489 that we earned on our income statement was paid out in dividends. So you take the difference between 2489 and the 474 and get 2015. That's dividends paid. Okay. We have this piece of information at the bottom. The accounting records indicate that Henderson paid $196 on its long-term debt. That makes sense because that's what they showed last year as the current portion, which is what the definition of current portion is what you're going to pay in the next year. So that is consistent. But we emphasize that it did actually happen as planned at the end of 2024. So we picked that cash paid on long-term debt, 196. So if we had no new debt, we would expect, if we didn't borrow any more, we would expect our total debt to go down by 196. But when we compare the long-term debt and the current portion, we add those two together there and those two together there and compare them, okay, it doesn't go down. It doesn't go down by 196. It goes up. Okay, therefore we must have borrowed more money. Take the difference, add the 196 because we borrowed enough that it overshadowed the 196 and still made our debt go up. Okay, so take the difference and add the 196 and you get 1425. And then this last one is long-term liabilities. One thing that we haven't dealt with is long-term liabilities. There's a difference of 32 up. So our cash from financing added up is actually negative 1707. We paid more out for treasury stock and dividends than we borrowed in new money and new debt. So taking 4017, 1648, 1707, we get 662, which was the change in cash we are trying to explain. Okay, as we went along, we could either just do the calculations with a little short description and then come back and make it look better. We kind of did it sort of at the same time, but of course this is still not presentable for in real life. We'd have to polish this up some, change the wording in certain cases, take out our explanations, things like that, make this more readable for our readers of the financial statements. But we've got the basic idea of a cash flow, and that is from there we could do the two required disclosures, the cash paid for taxes, by considering our tax expense on the income statement and the changes in tax liability on the balance sheet, and interest, cash paid for interest. So we take the interest expense on the income statement and the change in the interest payable on the balance sheet to come up with how much cash was actually paid for those two items. That is a required disclosure at the bottom of every cash flow statement. So there is your example on how to work through that. Each step, one by one. Good rule of thumb is to just check off each item you use on the balance sheet. You should have a place for everything, including, in this case, accumulated depreciation. That was explained by the depreciation expense on the income statement and the depreciation that was gotten rid of when we sold the property, plant, and equipment. Okay, that's how you make sure your cash flow is going to work, is making sure you didn't skip over something, forget to include it. If you do, it's not going to work because has to balance, right? Just like the balance sheet does, it has to end up with the change in cash.